Hi, you guys. Welcome back to the channel. My name is Brad. This is the Firefighter's Financial Toolbox. A lot of people are starting to get really nervous about what's been going on in the stock market lately. And for a good reason. We've been on a long bull market. So what exactly is the difference between a bull market and a bear market? And how does that work? A bull market, first of all, is good. A bear market, most people think of as bad. But let's get into that. So, are we in a bull market? So let's look at some key takeaways to start with. Now, this is Investopedia site, you guys. A bull market is typically designated by media outlets as a rise of 20% or more from a near-term low. But often, there are long periods of the market going up. Likewise, bear markets are called when an asset falls by 20% from its high. However, these heuristics don't always make sense in practical terms. Calling a bull or bear market often requires a greater degree of judgment as well as considering the condition of the broader economy and market psychology. All right, so let's define bull and bear markets. In its simplest definition, rising prices signify a bull, lowering prices or falling prices, a bear market. Right? Okay, that's an oversimplification. So, let's talk about some phases when we're talking about bear markets. Unlike bull markets, which, as we said, are usually defined by prolonged rallies, long-term going up, the first phase is characterized in a bear market by high prices and high investor sentiment. Everybody's starting to get worried. Towards the end of this phase, investors begin to drop out of the market and take in profits. So, put that in simple terms, the market's been doing good. We've made profits. We're going to sell some of our winners and suck in the gains, right? In the second phase, stock prices start to fall sharply and trading activity and corporate profits start dropping. This is sometimes economic indicators that may have once been positive start to become below average. Some investors start panicking as this starts. This is referred to as capitulation. All right, third phase shows speculators start to enter the market, consequently raising some prices and trading volume. So they're trying to cash in on the fact that things are starting to go south, right? They're starting to bet on falling prices. In the fourth and last phase, stock prices continue to drop, but slowly as low prices and good news starts to attract investors again, bear markets start to turn around. So the economy matters. Right now, you guys, let's be honest. We have inflation that's out of control, the highest it's been since 1982, we've got some indecision on how we're going to deal with our $3 trillion deficit due to the big pandemic. And we've got some geopolitical stuff going on, right? We have trade problems with China. People are worried about the Ukraine. I don't like to get into politics, but we don't know what's going to go. So the other thing, the reason the economy matters is usually if our GDP, that's the gross domestic product, declines. So let's talk a little bit about investor psychology. Because the market's behavior is impacted and determined by how individuals perceive that their investments are doing, when stocks start to fall, people start to get worried. You guys, this is the last thing you want to do. You want to stay. During a bear market, market sentiment is negative as investors begin to move their money out of equities and into fixed income securities. They're taking their money out of the risky stock market and they're buying safer bets. They're buying bonds. They're going to cash. The problem with that is when you sell and the market is down, you've locked in the losses, you guys. This is actually the time when you should be happy and buying. Now that's hard to do because you don't know where it's going to go. So let's talk about the bottom line here. There's no perfect way to label a bull or bear market. It's easier to focus on specific time frames or to consider sequence of peaks and valleys on the price chart. In simple terms, you guys, think of it like this. The market ebbs and flows every day. It goes up and down a little bit every day. Now, in the last week or so, we're down about 10%. So technically, at 10%, that is considered a market pullback. Okay? When it gets to 20%, then we're technically in a bear market if it goes from the high to the low. We're not there yet. Yes, it seems like we've had a lot going on and definitely gone down. But you guys keep investing, stay the course, continue to invest no matter whether it's up or down. You're going to win the race. Over the long term, the stock market always turns around. All right, you guys, hope you got something out of this. If you did, give me a thumbs up.